Recording in progress.
Hello and great day. My name is Nekia Foxx, and we will be going over our 2.5 assignment mini case study. Today is February 6th, and it's on the Part C study. So if we just go on the first page, if you just scroll down with me, we're going to go into the presentation. So this is a little bit of background and introduction to this particular case study. Parsi manages a team of professional buyers responsible for procuring all of the company's raw materials. This includes hundreds of millions of dollars of materials, chemicals, and plastics each year from around the globe. These materials are used to manufacture the company's products, including raw new line of refrigerators that was launched last year. The company sets a public earnings targets, so it's critical that the forecast is reliable. Unfortunately, Parsi's forecast the last quarter was off by a large margin, which now has to be justified and corrected. The engineering team estimated that each refrigerator contains 11.22 pounds of polyurethane foam, an expensive chemical used for insulation. A physical inventory count conducted at the end of the quarter determined that $350,000 of the polyurethane was missing. More than 11.22 pounds was being consumed in the manufacture of each refrigerator. That adjustment resulted in Parsi's forecast counts and the cost of goods sold to be off by $350,000. So what we're going to do is go into this presentation and go over what is taking place and how we can solve or give suggestions. So I know you want to know, what is a journal entry so that we can conduct this particular audit and be able to assess how to look at where the cost of goods is missing and how to be able to allocate them properly. So the first thing we're going to go over, what is a journal? It's basically a transactions of initial recorded chronological order in the journal before you're being transferred to the accounts, right? Every company has a general journal, which contains the space for the dates, the account titles, the explanations, the references, and 2 money columns. This is an example of a journal entry. And this is, you see the debits and credits, you see the dates in chronological order, and then you see the particular items that are going down as follows. Then we want to go into what is a T account. So the T account is what you just seen previously. It's an informal term for a set of financial records that uses double entry bookkeeping. That's where you've seen above, where the left side of the debit and the debit and credits. So you see it right here. Assets equals liabilities plus owner's equity. So you see this is an equation for that particular. You'll see the debits and credits on both sides going down to the paid in capital, retained earnings, revenues, expenses, dividends. And this is the formula for cost of goods services. Cost of goods sold is recognized as COGS, and it's determined by using the inventory balance through the following formula. COGS, which is cost of goods, equals opening inventory plus purchase items minus the closing inventory. That's a particular equation for this. And this is how the inventory transactions are related to the cost of goods sold. And this is an example of when we're going in and we're showing exactly on our journal entry how to allocate the $350,000, how we can show it on our journal in a T count account. So you're seeing the $350,000 right here in the cost of goods sold in a debit. And then as in the inventory, you're going to see it on the credit side right here. Then we go down the cost of goods sold. That's the $350,000, which balances back off on the inventory area of $350,000 again. And here is our suggestions for this particular situation that Parsi is now having to justify and correct. So the recommendations would be to avoid the errors in order to avoid the errors in the future. It would be to obtain some service experts to input the material consumption to eliminate the forecasting discrepancies. Due to the engineering team, of course, inputting it incorrectly, we're estimating that the incorrect amount inventory is the root cause of the cost of goods services being misallocated or miscalculated in the financial statement. So this can be avoided in the future by implementing a periodic review of the estimates made for consumption of raw materials and specifically compare the actual quantity being consumed. So this is our summation of Parsi's error that is now being corrected for our case study 2.5 assignment. Thank you and have a wonderful day.